But like the way that Warren Buffett thinks is like that. So people always criticize him for holding so much cash. or like short-term bonds. It's like, well, what is this guy doing? He's like being so defensive. Like it's like the market's like going crazy. Like why wouldn't he be buying stuff, right? But if you look at like 2009, what happened? There's a huge market crash. Everyone's running around with their heads on fire. And what does Warren Buffett do? He's like, okay, I'll go and I'll buy North America's largest railroad. Yeah. And he's like, yep, this is a good buying opportunity, so I'm just going to pick up a railroad. Yeah.
Oh, yeah.
Hey everyone, welcome back to Average Guy Finance. I'm Vic.
I'm Darren.
Okay. So I think today we wanted to talk about...
Well, okay, so we did 2 videos last week, and the first video got 64 views, and the second video got 34 views. Not a lot of views, but we got a lot of questions. We got people writing in to ask us things about things we were talking about. So I thought it might be fun if we answer some of the questions.
Okay.
Yeah?
Cool.
All right. Okay. So the first question comes to us from Dave in B-Town. He just put B-Town. Okay, so Dave says, hi Vic, hi Darren. I'm a skeptic. The S&P 500 is at an all-time high, which it is, and it's getting higher every day. Is this a stupid time to get into the market? Isn't it going to crash?
Okay. So it's kind of like, it's actually surprising how many days the S&P 500 makes highs.
Okay.
Because I think like this week, pretty much every week, there was like a new high that it made.
A new historical.
Yeah. And if you think about it, like the market just kind of just goes up and up and up and up. Like there might be times where it kind of dips, but it's just making new highs all the time. Maybe not every month or even every quarter, but the progression over time is definitely higher and higher and higher.
Okay.
So that's like, just because the S&P 500 is hitting a new high, that's not necessarily a reason to not be in the market.
So you think even with it at a high, don't worry about that, get into the market. If there is a correction, it's going to climb back to where it was, where it is now. Okay,
so let's look at an example. So like when I was first getting into the market, I was kind of nervous about that too, because like you kind of look at the market crashes that happened in the early 2000s and 2008 and 2009, right? And you're like, okay, I don't want that to happen to me. But the problem with predicting the way markets are going to happen is that you really have no idea what the market is going to do in the next month or the next year, or even in the next decade, right?
Okay.
So you can decide, okay, I'm just going to sit the market out until there is a correction, but that might not happen for another 5-6 years, and you've missed out on all that growth and all those dividend payments.
Okay.
Right? So I mean that's why.
So even if there is a correction, let's say 5-6 years down the road, if you got into it now and experienced that correction, you would be in a better position then. Than had you sat it all out.
Yeah, and there are ways to strategize around that.
Okay.
So let's just look at it. So like one thing you do is it's called like dollar cost averaging.
Okay.
So let's say like you have your core index ETFs. So that's basically stuff that's tracking the whole economy, right? Or you have a list of your favorite stocks.
Right.
And you're just saying like, okay, every month or every 3 months or whatever schedule it is for you, you're just putting a set amount of money into the market to work, basically. And you just keep doing that. So if the markets are high, you're going to be buying in and it's going to be like a higher price. But if the market drops, you're going to buy in and you're going to get a better price. Okay. But it's like, in order to do that, you're just continuously accumulating shares in the economy,
Okay.
in your favorite stocks. And so that's one way of doing it, where you're always going to be participating in that growth.
Okay.
And then if it does crashes, then you have an opportunity to buy at lower prices.
Is there an okay? All right. Why are people? This would be a good time for you to do that analogy about the TVs. Vic has a good analogy about television. So I was still playing the skeptic in real life when he was before I had started investing, and I was worried about crashes, and then he used an analogy that kind of made that make sense to me.
Yeah, but think about it. So like, you know how everyone gets excited about if big screen TVs go on sale?
Oh man, I get excited. Yeah,
And
I can't wait until what is it called? Black Friday. When you go to Best Buy, you just punch people.
Yeah, people are literally stampeding over themselves, right?
To get a TV.
But when stocks go on sale, people want to jump off a cliff.
Right.
So it's like everyone thinks like this is a problem if their favorite stocks or the market goes on sale. It's like no, it's not a problem at all.
And it's not a problem because they should be looking at that as an opportunity to buy more stock, right?
Yeah, for sure.
Yeah.
And the problem is like, okay, some people they'll say, okay, well, I'm just gonna wait for that buying opportunity.
Mm-hmm.
But I mean, you can't do that either.
No, because that might never come, right?
Or you don't know when it's going to come.
Right.
So it might be, so like the bull market that happened just recently, it went from 2010 until 2020.
10 years.
Yeah. So
10 years.
So picture yourself in 2012, right? And you're saying, you know what? I'm just going to keep my money on the sideline in cash.
Because this looks too high right now, right? Like this looks a little too high, this bull market.
Yeah, and I'm just going to wait it out until there's like a crash. Right. Well, like you would have waited 8 years for any sort of significant buying opportunity.
And it would have taken a global pandemic, which is what it took to crash, right? Because otherwise it wouldn't have crashed.
Yeah. And it's like, and you're missing out on all those dividend payments that you could have been getting.
Mm-hmm.
You know, so it's it doesn't make sense to be completely out of the market either.
All right.
So so here's another strategy you can use. So let's say the market is at all-time highs and there's like a lot of exuberance and excitement about the stock market, right?
Okay. Which there is right now.
For sure, yes.
Yeah, okay.
And so you don't necessarily have to be buying all those high-flying stocks.
Okay.
So
what would be an example of a high-flying stock that you don't need to be buying?
I would say for sure like Tesla. Okay, that's like the king of high-flying stocks.
Okay.
But like anything, like a lot of these like kind of tech names, I guess you can say, right?
Okay.
But you can say, you can kind of take this the contrarian viewpoint and say, okay, instead of putting my money into stuff that everyone's excited about right now, maybe there's value in buying such like a gold mine company, or like utility companies, or maybe even bonds. Like even though bonds aren't paying a lot right now, and you could buy some like short-term bonds and still get some value off of that.
And it's interesting that you mentioned utility companies, because are they relatively low right now?
Yeah, because it's like in terms of like when things are going really really well, people don't tend to want to buy stuff that's
boring. Okay.
Everyone wants to buy stuff that they think is going to make them like 20 or 30% a year, right?
Right.
When a utility company is going to pay you like a solid 4 or 5% dividend, people don't think that's really exciting.
Right.
But when you get to that point where there's like a market crash, then those companies look very attractive to people.
Because everybody needs lights and heat.
Yes.
And
those companies are always going to be doing well.
Right.
So like in a market crash, like maybe don't put all your money into the high flying stocks. Make sure you have some defensive positions as well.
Okay.
So.
Yeah.
And remember, you can always. Okay, so let's say theoretically there is a market crash, right? And a lot of market crashes, they do last 2 or 3 years, where the market's kind of like not doing so well.
Okay.
But chances are, if you're properly invested, you're going to have dividend payments coming in.
Right.
So you have payments coming in, and you can use those dividends to buy up stocks at a discount.
Mm-hmm.
So you can buy, just for example, you can buy Coca-Cola for a 30% discount.
Right.
Or you can buy McDonald's at a 30 or maybe even 40% discount, right?
Mm-hmm.
Which is good. And then also you can have your personal cash flow. So as long as hopefully you still have your job and you're budgeting properly, and every month you know that you're going to have like a certain amount of money coming in that you can invest.
Right.
That's money, like during a crash, you can be using that money to buy into stocks as well.
And it's not, and again, tying in with our first video, I think, even in a crash, as long as you have invested in solid companies and hold those stocks, don't panic and buy those stocks, the market always comes back and you're going to be back where you were, if not farther ahead, right?
Yeah, it seems like the market always values companies that make money.
Yeah.
So profitable companies just don't stay down very long.
Okay.
So if you do get that opportunity, then yeah, you want to buy when the opportunity comes, for sure. Yeah.
Yeah. All right.
Mm-hmm.
All right. So
Yeah.
I hope that answers things for Dave. Yeah.
Yeah. So was Dave like was he concerned about like volatility, or like saying like, okay, I don't want to put my money in and end up being down 40% if there's a crash?
Well, yeah,
that's what he was concerned about.
Yeah, that's exactly what he was concerned about with it being up so high. He's worried that as soon as he puts money in, it's going to crash, and he's wondering if it can sustain the kind of growth, the kind of high that it's been on for the last.
Yeah, and I think like people like getting into the market when they're getting into the market initially and when they're starting out, that is like a huge concern of theirs.
It is.
It's like,
it was a concern for me.
Yeah, it's like yeah, I don't want to be putting like my hard-earned money into this thing and then seeing a 30% crash, right? But it's like,
but that's why you don't go with the high flying.
Yeah, you have to have like a balance.
Yeah.
Or you have like index funds, like ETFs, and that's what we suggest. Like if you are starting out,
right,
just go out and buy an index that tracks the S&P 500,
right,
or the Toronto Stock Exchange.
Because the S&P 500 is the 500 most.
The top 500 companies in America. Like you can't go wrong.
You can't go wrong.
It's like only that, right?
Right.
And really, like if you just want to stick just to index funds, that is a perfectly sensible thing to do.
Totally. Yeah.
And if that's all you do, that's perfectly fine.
I'm only finding this out now. I thought that like before I started investing, I thought you had to be going through sheets and lists of companies that are trading at like 12 cents and 5 cents.
Yeah.
How am I gonna know what to pick? But the S&P 500 they've already picked those companies for you. Those are the best companies in America.
And the thing about the S&P 500 is like, in order to be included in the S&P 500, those companies have to prove that they are profitable,
right,
for a number of quarters.
Yeah.
So these aren't just like.
Yeah, we can't start a company and just the S&P 500.
Yeah.
No.
These are companies that have a history of making money.
Right.
So it's like if you want to put your money into the S&P 500, it's a perfectly safe and sensible thing to do, for sure.
Right. Yeah.
So and I think like.
Oh, we have a visitor here. Come say hello. Come here. Come in. Say hello. It'll be cute. Come here. No, come here. Come here. Yeah. Okay. Good. You okay? Yeah. Sorry. That's cool.
So it's like, I think like with people is like, it's useful if people can understand what causes a volatility in the market.
Right.
Right. So it's like then you understand when the market does crash, you can have an understanding of like why this is happening.
Right.
Right. And how you can play it.
Okay. So this kind of ties in with our next question. Yeah. Should we go to that one?
Sure.
Yeah. Okay. The next question comes from Sherry in Lansing, Michigan, and she's asking about a specific stock.
Okay.
She's asking about Amazon. Okay. So Amazon was trading at over $3,400 a share in February, and then from February 10th, over the course of a month, lost $400 per share.
Okay.
So it dropped below $3,000 a share. And now it's climbing up again. So she wants to know what caused that drop in February. What could have caused that drop?
So it could be like a single company event.
Okay.
So I think specifically with Amazon, I think there was the union drive in Bessemer, Alabama.
Right.
So
was that going on? That started then?
Yeah.
Okay. All right.
So it's basically, I think, like, just with Amazon itself, like, people thought, like, okay, well, if Amazon is going to unionize, that's going to cut into profits, and that's going to hit the company.
Okay.
And I think, like, since the workers voted against the union, so that's brought the stock up.
Okay, so we're recording this on Sunday. What's the date today? April
11th.
April 11th. So on Friday, last Friday, the vote was announced that the vote for the union had been defeated, and I had the news on my phone over here, and I was watching the stocks on my computer over here, and as soon as the story came out, the Amazon stock started going like this. Yeah, right off the screen.
And I mean, to me, it was, so for the stock, it was good. For Amazon, the company, it was good. But, like, I think I was a little bit disappointed.
I was disappointed too.
Because it's like you understand, like, okay, Major League Baseball, all the players understand that having a union is good for them.
Yes.
Okay.
They do. Yeah.
And if you look at, like, doctors' associations,
Right.
they understand that having a medical association that represents them as a whole is a benefit to them.
Yeah.
Police unions, teachers unions.
I am part of a union that
Yeah. And I've had an opportunity to be part of a construction union. You know, it's like, and I was a little bit disappointed with, I guess, not so much the workers, but also, like, Amazon itself, because they spent a lot of money, you know, trying to get the message out there to the workers that, oh, having a union is bad for them.
Right.
And it's like it was kind of, it seemed a little bit to me like kind of like a propaganda, and union busting.
Right.
Yeah.
And I'm not anti-Amazon. Like, I love Amazon. I order stuff on Amazon every week.
Yeah.
But you would think that I was a little disappointed because you would think that a company that big could have set an example with how they treat their workers, right? They could have set a precedent for every other.
And I think, like, some of the workers, like the worker demands were like, okay, can we get some, like, decent washroom breaks?
Right.
Can we get air conditioning?
Air conditioning, yeah.
Like, can we? Though those are very reasonable demands. It's like really, to me, I think that's like just human decency.
Yeah.
But I was disappointed that the workers decided to vote against the union.
Yeah.
But I mean, it is what it is. I mean, that's
yeah.
So I mean, that's like a single event that could affect the stock price, but also it could be like a macro event as well.
Okay.
So
what would that have been?
So we talked about, like, in our last videos as well, where a lot of these high flying tech stocks took a huge hit. Okay.
In February as well.
In February. It's like right around the same time. So it's like at that time, and it really takes like a catalyst of some sort. And in this case, a lot of people are pointing to the 10-year U.S. Treasury.
Okay.
And it went from about 0.9% to and it rose to as high as like 1.7%.
What does that mean?
So that's like the U.S. Treasury. That's the interest rate that you're gonna get if you're holding bonds tied to the U.S. Treasuries.
Okay.
That's the interest rate that investors are gonna get from that, right?
Okay.
So if investors like they picture yourself as like a pension fund, or for example, or like one of these big institutional investors, they're gonna look and they're gonna say, okay, well, maybe right now we have a ratio of 85% stocks and 15% bonds. If we see that there's like a movement where bonds are now paying a little bit more, maybe we switch and maybe we shift to maybe 80% stocks and 20% bonds.
I see.
Right.
Okay. So now when they do that and they when they when they sell off their tech stocks to do that, that lowers the price of the tech stocks.
Tech stocks.
Okay.
And it also could be just other companies, like, so for example, like Berkshire Hathaway. So they had, their biggest holding is Apple, and they have other tech holdings, right?
Right.
So they might say, okay, well, tech's done really, really well so far. So let's maybe trim our positions from that a little bit and move it into like other areas that we see value. So they sold a little bit of Apple and other tech stocks, and they moved into some pharmaceutical companies, and they made a big play into Verizon, for example.
Okay.
Because they saw an opportunity in Verizon. And that's perfectly normal behavior, right? But the problem is what causes market volatility then is that all these people who, they were basically betting that the market was just going to continue going up for these tech stocks. And they were highly leveraged. So
what does highly leveraged mean? Would that mean that they had borrowed money to invest in those? Okay. So they used credit to invest.
Credit.
Okay.
And that's something that we never...
No, you never wanted to.
We never recommend. So like a lot of these guys, like they had like 10 to 1 leverage or even higher. So for every dollar that of their money they were investing, they had $10 of borrowed money, right? Ow. So even like a little...
How do you sleep at night?
Yeah. So even like a little downturn causes a big impact into their positions, into their holdings.
Right.
And just even like a little downturn...
So Berkshire Hathaway selling off a little bit of Apple would have dipped that stock a little bit. That would have...
Yeah.
Okay. Yeah.
And it would like and other stocks as well. So then someone who's highly leveraged, their broker would be like, hey, look, your holdings went down 5%, but because of all your leverage, we're not sure that you have the money to back this up.
Right.
So you need to either put more money up, or we're going to force you to sell your positions at a loss.
Is that a margin call?
That's a margin call, yeah. So they get margin called or they get liquidated.
Okay.
So liquidated basically means that the broker is going to sell your positions for you.
Wow.
And they're going to force, because the broker, like they're saying, no, we're not going to take the risk that. So if there's like a little like 5-10% downturn in the market, we're going to sell your positions for you, and then you're going to get liquidated. Wow. So you're going to basically take a loss.
Wow.
Yeah.
Ouch.
But then that causes a domino effect.
Okay.
So look at it. So all these, the first catalyst is that these pension funds or someone like Berkshire, they're going to trim some positions. That's going to cause margin calls and liquidation for heavily leveraged investors. Then that's going to cause all these companies to lose further value. And then maybe like retail investors, they get nervous and they like, okay, well, my position just lost 10%. I'm going to panic sell.
Yeah.
That causes another drop in price.
Right.
And then other people get margin called and liquidated. Okay, so you can see this domino effect where...
And you can see why it takes a month, right? Why that happened over the course of a month. Yeah. Okay.
And then you can see like we were talking about in our other videos where these tech stocks, like maybe even like perfectly good companies like Tesla, they lost like 30%.
Right.
Right. That's how stuff happens. Right.
Yeah.
It's because there's a lot of YouTube advice going on right now. Okay. So there's one YouTube guy is really famous, and like if you follow his procedure, you can see exactly how market crashes happen. Okay. Okay. So let's like do like a Cold Note version of his theory. Okay. Or is how he does it. Okay. So I guess step one would be. So he's
use
saying
all your credit. Is that step?
So he's speaking like he'll put out a video saying like, okay, this is how you take $10,000 and you turn it into $100,000. Okay. And people get very excited about that.
Yeah, because who wouldn't want $100,000, right?
Yeah. Right. So yeah, and okay, so you start with $10,000. Okay. So I guess step one, unofficially, is that you have to pay this guy $700 for his stupid course that he's selling. Okay. All right. So now you're down to $9,300. Okay. All right. Okay. So then he says that somehow with your $9,300, you buy a house.
How do you buy a house with $9,300?
Yeah. Okay, so let's give him the benefit of the doubt.
Maybe in the States you can buy
Maybe.
like,
Well, then there's low interest rates, right?
Yeah, right.
So obviously he's telling you to basically take like a very high leverage mortgage.
Okay.
So
Buy a house.
he was saying basically put 3% down, which I don't even know is possible.
I don't think that's possible.
But let's give him the benefit of the doubt.
Okay.
And let's say that you end up with a house.
Okay.
And then he's saying, okay, so you put a little bit of money into improving the house, put some new carpet in, give it a paint job.
Okay.
And then somehow you end up with $100,000 in equity in your house. Okay.
Okay.
So let's just work with him. Let's just work with him. Okay.
Right.
Okay. So then, but then, so he's not telling people just to sit on their equity and just enjoy the fact that they have money in their house.
Mhm.
No, he's saying you should borrow your equity.
Okay.
And he's like, oh, it's only going to cost you like 4, 5, 6% to borrow against your house.
Okay.
And then you can put that money into the stock market. And is he going to tell you to buy sensible stuff? No.
No, looking at the chain.
Yeah. He's going to tell you to buy the most risky, high-flying stuff there is.
Okay.
Right? And so you basically have the recipe for a market crash. Because it's people who are, they're borrowing against their house and they're paying interest on this, and they're putting into risky bets into the stock market.
Right.
And he might even tell them to, when you're putting your money into the stock market, leverage that money.
Oh,
Yeah,
okay.
if you can. And it's like a lot of these online stock broker platforms, right?
Mm-hmm.
Normally, if you go to like a traditional bank broker, they're not just gonna give anyone margin.
Mm-hmm.
Like you have to really prove your credit worth.
Yeah, you gotta come
credit,
in.
right?
You gotta be.
Yeah.
Yeah.
But these online credit brokers that are springing up, they'll just give okay, you're like an 18-year-old kid somewhere.
Mm-hmm.
Okay, here's some margin.
Wow.
Go play in the stock market.
Now,
Yeah.
is it safe to say that those companies that are springing up to give anybody margin, are they kind of hoping that you?
Yeah, I
Or
mean,
yeah.
again, they don't really care because it's
Right.
like they're not going to lose money because
Okay.
if they have any risk of losing money, they're gonna margin call you and they're gonna liquidate you.
Right.
So they're not gonna lose by you taking risky bets.
Mhm.
Only you are gonna lose. And these companies like the broker that we use when we make trades, do they have fireworks and confetti going all over the place?
No. If anything, before you place
Yeah.
a trade, there's like 5 or 6 warnings, right?
Yeah.
Before you're allowed to put the trade through. Yeah.
So it's like, come on, we're serious people here. Why do we need confetti when we're making stock trades?
Right.
But these online brokers, they think no, confetti is good.
Right, because
We need confetti.
It's going to set off
Yeah.
endorphins and
Yeah. So yeah, they understand human psychology.
Yeah.
So it's like they know let's make this like a fun thing. So let's
make it a casino. Let's
yeah.
make it a casino. Yeah.
Exactly. Yeah. So it's like it's also the tricks that casinos use.
Right.
Because they always have sounds going. They pump in oxygen to make you kind of euphoric. They have waiters going around with
free drinks.
With free drinks.
Yeah.
So it's it's, and when people think the stock market is a casino, in some respects it is.
That's why.
Yeah.
That's why you said that in our first video that there's kind of when I was playing the role of a skeptic in the first video, you were explaining it to me that the stock there's basically two parallel stock markets happening, right? There's the casino and there's the sensible investors.
Yeah, there's the patient, intelligent investors, and then there's the over exuberant ones who they want to make the quick buck.
Right.
And they're the ones who are using the options trades and the leverage trades. And basically the way the options work is options trading, have you heard of options trading?
No.
Okay, so options trading is basically, in a sense, it's you're betting that the stock is going to reach a certain level, and it's either going to go higher or it's going to go lower.
Okay.
And so if you think the stock market is going to go, the stock is going to go higher, you're going to say, okay, I want to put a call option that the stock is going to go from 200 to 250 for an example.
Okay.
But like the best way to explain it, that's basically like saying that I think Tom Brady is going to throw for 400 yards this Sunday.
It's gambling.
Yeah.
Right. Yeah,
And so if Tom Brady throws for 400 yards, you get paid.
Right.
If he doesn't throw for 400 yards, you lose.
Okay.
So that is gambling to an extent. So like when people say, "Oh, the stock market is a casino," it's just like legalized gambling. In a way, they're right because people are doing it like that.
Okay.
And you can do it like that. But there's also the parallel system of intelligent, patient investors.
Right.
And that's where we recommend that people be.
Which, I mean, a skeptic could say that still is gambling, but it's not.
No, it's investing.
Okay.
Yeah.
Right.
There's a difference between gambling and investing.
What would you say the difference is if you had to sum it up, if you had to just...
Yeah. I think the best quote that illustrates it all is from Warren Buffett.
Okay.
So he says that stock market it's a mechanism for transferring wealth from the inpatient to the patient.
Say it again.
The stock market is a mechanism for transferring wealth from the inpatient to the patient.
There you go.
Yeah.
Wow.
Yeah. So like the impatient people are the ones who they're using debt to invest in the stock market, right? They're using options to invest in the stock market. The patient people who are doing it sensibly, they're not using debt. They're just steadily, consistently over time accumulating. And that's where you want to be. And so like the way you want to think of it is like that all those people's overexuberance that we're seeing now, because basically they're saying like the amount of leverage that's in the system right now in the stock market, it's basically at all-time highs.
That's not good though. That could lead to a definite...
Definitely can. Yeah, it's definitely, but it's like, but as long as you're not part of that circus, you're okay.
Now, but you could still see your stocks go down, but they are going to come up.
Let's just break down what Warren Buffett was saying with that quote.
Okay.
So like,
it's a nice quote. I think I want to have we should have like a picture of Warren, right?
Yeah.
Because I have a crush on his brain.
Yeah. Okay. So basically, when if you think about like when money is created and destroyed, so people think like, okay, if the stock market crashes, that whole bunch of money just got destroyed.
But it didn't.
No, it mostly just got transferred.
Where did it go?
A lot of the money got transferred into safer assets, such as cash or gold or bonds or something like that.
Okay.
Or it's just like sitting on the sidelines.
Now, when you say safer, those are safer assets because the market is going down, right? They're not necessarily safer all the time. Or are they safer because they're fixed, because they stay...
Yeah, like the bond, you know the bond's going to pay you like a certain amount.
Okay, bonds, but
you know cash is going to pay you a certain amount.
Okay.
And like gold for a long time has been a safe asset.
Yeah.
It has like a 5,000 year track record, right?
Yeah.
So it's just, we do see that during market crashes, investors do want to take a portion of their holdings and they want to put it into safer assets.
Okay.
Just for safety, right?
Sure.
But... And if you think about it, so when we talk about money creation and money destruction, money creation happens when there's new debt. So if someone goes and buys a $20,000 car, money gets created.
Okay.
When someone pays off their $20,000 car, money is destroyed.
Okay.
So when someone goes into the stock market and they borrow $50,000 to bet on the stock market, money is created. It's destroyed if that person can't pay their debt.
Okay.
That's when it gets destroyed.
It gets okay, wait, but they can't pay their debt because the market didn't go up for them, or it didn't do what they wanted to do.
Yeah, but in a way, it doesn't actually get destroyed because they still owe the $50,000
Right,
debt.
right, yeah,
Right.
yeah.
So, but it's like, but the value of their holdings went down, but they're still stuck with a $50,000 debt.
So they're gonna have to find a way to create that.
Or they go bankrupt.
Yeah, right.
And then that money does get destroyed, right? But like the way that Warren Buffett thinks is like that. So people always criticize him for holding so much cash. or like short-term bonds. It's like, what is this guy doing? He's like being so defensive. Like it's like the market's like going crazy. Like why wouldn't he be buying stuff, right? But if you look at like 2009, what happened? There's a huge market crash. Everyone's running around with their heads on fire. And what does Warren Buffett do? He's like, okay, I'll go and I'll buy North America's largest railroad. So he bought Burlington Northern Santa Fe, which is North America's largest railroad. And
because he had the cash to do it.
He had the cash to do it, and everyone's panicking. And he's like, yep, this is a good buying opportunity, so I'm just gonna pick up a railroad.
Oh yeah, right.
And that for Berkshire, I mean that's such a like, it's making them so much money every single year.
Everything needs to go on the railroad, right?
Yeah.
Like it's how, yeah.
And it's all the grain shipments and all the oil shipments and the merchandise shipments.
Yeah.
It's like, that's why Warren Buffett is
the oracle.
Yeah, that's why like Berkshire is such a good company, because Berkshire, it does well in good times, but it does excellent in bad times. Right? Yeah.
Isn't that the kind of human being we should all be striving to be?
Yeah.
Good in good times.
So so I guess like to sum it up, it's like, no, you shouldn't be afraid of market crashes. Okay. So it's like, okay, so if the market is overheated, you're still investing a little bit, but maybe you're investing in more defensive positions. Maybe you're keeping a little bit of cash on the side. Maybe if bonds are paying well, you're putting a little bit of money in your bonds. Okay, and you're structuring your portfolio in a way that's it's balanced. And you're looking at all possibilities.
Right.
Okay. If you go all out attack all the time, like we talked in our old video, like with the soccer analogy. If you go all out attack, you're gonna get crushed.
Right.
Okay.
Yeah.
So you want to have.
You might have the occasional game where you steamroll somebody. But, But over the course of an entire season, no.
Yeah. So you want to have a balanced portfolio.
Yeah.
And then, and it's basically like it's. Knowledge and education is your best asset.
Okay.
So if you understand the game, you'll know how to play this well.
Right.
Okay. You'll know when to buy bonds. You'll know the time to buy gold stocks, or like when to hold cash, or like, and that's why I encourage people to like just go out to your library and read as many books as possible. Okay, guys. So I hope that answers Dave and Sherry's questions. Yeah. But it's like, okay, so I think that the best way to think about it is like that you want to be the patient, intelligent investor.
Yes.
So just picture us like, okay, we're just like sitting back, imagine Warren Buffett's on this side, Charlie Munger's on that side, and we're just, we just got our popcorn and beer.
And Diet Coke.
Yeah. And we're just basically watching the circus in front of us of all this like craziness with people using debt and all these crazy things to like to invest in the market.
People going broke, people losing their minds, and
But we're just watching, and we're just like looking at the clown show in front of us.
And how long have those two been watching for?
Like combined?
Yeah.
Oh, it's centuries. Yeah. Right.
We're talking about Warren Buffett and Charlie Munger who've been at this for when did they start?
Pre-World War II. Like
started in
Yeah.
Have just been they have been unaffected by all of that.
Yeah, they have such a like casual view of everything. Like they never get too excited. They never get too down.
Right.
You're just watching stuff unfold in front of you, and you're just making intelligent decisions.
It's very zen, isn't it?
Yeah.
Isn't it? To be
that's what you want to be. Yeah.
Right.
That's good. Yeah. Let's be Zen investors. Okay?
Yeah.
That's a good way of putting it.
I like that.
Okay.
I like that.
All right, guys. Thanks for tuning in. I'm Vic.
I'm Darren.
Okay.
Yeah.
And See you next time, guys.
See you next time. Bye. Thank you. Like and subscribe, by the way.